Hello, I'm Karthik Ramanna, and I'm a professor at the University of Oxford and also a co-founder of the E-Ledgers Institute.
And Bob Kaplan, professor, now emeritus at Harvard Business School, and the other co-founder with Karthik.
We're delighted to be back here at the Accounting in a Sustainable World conference. We have had the distinct honor and pleasure to have been invited to this conference every year since its founding. And this conference has more or less tracked over its lifetime the development of the E-Ledgers methodology that we first conceived and published in 2021. This year, we are going to focus on our theory of change. We've spent our last few years developing out the E-Ledgers methodology, both on the liabilities or emissions side and on the removals or asset side. And we are increasingly gaining traction with policymakers, with corporations, with others who are engaged in decarbonization, particularly pro-market approaches to decarbonization. So in this year's session, we want to focus on our theory of change.
But before we get to the theory of change, for those who were not with us in the previous years of our presentation or could use a refresher, we're going to spend just a few minutes telling you what E-Ledgers accounting is all about. This was introduced by Karthik and me in a 2021 Harvard Business Review article. And it's actually a very simple system. And so just a short disclaimer, many of you in the audience are likely familiar with some of the existing methods of disclosure of carbon emissions, whether it is EPDs, environmental product declarations, life cycle accounting, greenhouse gas protocol. And for purposes of this session, it would be best if you could, in a way, just suspend your disbelief for a moment that something as simple as we're going to describe can actually work. And don't try to compare it to anything existing. Just try to have this open mind. And then we will talk about how this becomes practical, in the latter half of this talk. Okay, so fundamental idea is really every entity. Suppose you had everybody on this system. So that's going to be the desired future state that we are trying to get on a trajectory toward. And every entity, for-profit, not-for-profit, governmental, measures all its direct emissions, some version of scope 1, if that's helpful. Okay, and so we still have that. And the reason, obviously, this is important, these are the only emissions that go in the atmosphere, only the direct emissions. So it's important that we measure them when and where they occur. Now, suppose your entity is in the middle of a supply chain where you are purchasing products and services from other companies and somebody is consuming or purchasing the outputs that you're producing. In a way, this is a verbal proof, mathematical proof of induction, which is to show it works. How does this recursively occur for each stage down a supply chain in this case? So assume that all your suppliers are transferring in the emissions that were produced for the products and services that you're purchasing from them. Okay, so assume you're getting a report from all of your suppliers of the embedded emissions in your particular purchase products and services. Then you add together the emissions you produce, your direct emissions, plus all the emissions you purchased, and you allocate them to the outputs that you produce. And there's an analogy here in cost accounting where you take all your spending for a product, the materials, the energy, the infrastructure, the machines, and allocate it to the outputs. We developed this in activity-based costing 40 years ago. So a very analogous procedure, allocating all your purchased and direct emissions to your output products. If you do have some legitimate removal offsets that you've purchased in the past that have actually removed carbon from the atmosphere, you have the option of using those removals to lower the amount allocated to your output products. But if you don't have those, and most organizations don't, just skip this step. But the final step is now all the emissions that you've produced, direct and purchased, are now allocated out to your output products. And when you sell that output product to your immediate customer, they get that report, they inherit those emissions. And that's really step two. That's why it's a recursive process, because now this is repeatable down all supply chains. So that's the whole idea of how we move emissions, all the direct emissions, eventually move downstream to the purchases of those products and services, eventually ending up with the end-use corporation or end-use consumer. Karthik, maybe you can comment about why we like this approach.
That's right. And, very often, many people confuse the notion of the term accounting to mean something associated with the presentation of accounts. Obviously, the presentation of accounts is important, and, what kind of format of reporting or disclosure it might take is valuable. But the core function of accounting is the transfer of information through complex value chains. And how do you reliably transfer information when that information is generated in different parts of a complex value chain? That is the core insight of accounting, and that is the core approach that the e-liability algorithm addresses. This is what economists often call the information problem, right? Which is if you're a company trying to measure your cradle-to-gate emissions impact, much of those emissions took place many layers above you in your supply chain. And you don't even know the identity of those companies that generated the emissions, let alone what the quantity of those emissions are. So the idea that you can sit where you are in the value chain and imagine what those emissions are, that becomes something that's very hard to do if you want the rigor of accounting associated with the number.
I mean, you can imagine them, but they are imagination, not real numbers and not accounting.
Exactly. And that's the problem that the e-liability algorithm is really focused on solving. And the beauty of the approach that Bob just described on the previous slide is that only direct emissions need to be measured. And of course, they only need to be measured once at the point at which they occur. And once they are measured at that, then the algorithm effectively allows for their secure and reliable and accurate transfer down the value chain. So effectively, emissions are measured only once, and they are assured at the source of emissions. And then as they move down the value chain, those acquired emissions, as well as the direct emissions of the entity in question, have to be allocated to those entities' outputs. And those allocations are also in turn subject to some sort of assurance process. So there are three critical stages of the assurance process. One, when the direct measurement occurs and the measurement is recorded. One, when the direct measurement plus the purchased or acquired emissions are allocated to products. And finally, when those outputs are transferred to the next entity in the value chain. As long as all emissions are measured once and only once and assured at source, allocated to a level that is assured, and then transferred onto the value chain, the information problem is solved through this simple algorithm. And that is the most complex part of any accounting system, which is how to solve that information problem, rather than the reporting or the bookkeeping or the disclosure elements of it, where much of the current attention in the so-called carbon accounting space has focused to date. Now, the next thing we want to talk about, and in fact, the main thing we want to talk about with this primer on the e-ledger's methodology is our theory of change. Obviously, the world has gone through a profound set of changes even in the last 12 months. The zeitgeist of our times is economic nationalism. And in the context of that economic nationalism, global solutions to problems like climate change seem to be less politically salient. In the context of everything else that's happening in the world, including wars and famines and so forth, the notion that we can somehow have some grand global consensus on decarbonizing the planet seems to look quite far-fetched. So in the context of that environment, how can a robust and sort of technologically agnostic and ideologically agnostic carbon accounting solution like the e-ledgers methodology make progress? And that's part of what we want to focus on in this next part of our address to you. And so we thought we would, in full transparency, given that the E-Ledgers Institute is a nonprofit institute, we have no commercial stake in anything we're doing. We're doing it as a public good for creating incentives for decarbonization worldwide. We would share with you what we think is a credible theory of change, a credible strategy for the E-Ledgers Institute for the next 3 or 4 years as we navigate this, different political terrain. And our strategy or theory of change basically involves 4 buckets. The first is to continue our work in creating and growing a community of practice, and Bob will double click on what that means in a moment. The second is to continue our work. Bob and I are both professors at heart. That's what motivates and drives us every day. And so to continue our ongoing scholarship, developing and building out the E-Ledgers accounting solution in more detail, and to address some of the more complex accounting challenges that might present themselves geopolitically. The third is to scale the solution so that it can be quickly and cheaply applied across many different information technology platforms, many different geographies, and many different settings with perhaps very different institutional strengths. And the final one is to connect to the policy ecosystem, recognizing, of course, as I said earlier, that policy ecosystem has shifted dramatically even in the last 12 months. So what are the pull factors that might allow something like the E-Ledgers method to become policy salient in the United States, in Brussels, in other parts of the world where decarbonization might be part of the conversation on economic revival. So that's going to be our plan for the rest of this talk. And with that, let me turn it over to Bob to pick up on the first 2 of these points.
Yeah, so thank you, Karthik. So in our division of labor, I'm going to do the first 2 steps, much of which we've covered in previous talks. So this is really a review and somewhat of an update. And we'll have the bulk, I hope, the majority of the time remaining that Karthik can talk about items, the scaling and the policy impact. So when we first published the paper, we had the good fortune of speaking with the senior executive team of major regulatory agency, and described the method that I just shared with you a few minutes ago. And they said, well, that's great. Very interesting. It's accounting applied to carbon measurement and reporting. Who's doing this? And for once, both Karthik and I were silent. And then we kind of spoke up. We said, well, no one's doing it. It's just something we thought of once we confronted the problem. And he says, well, we can't really issue a standard to do something that no one has ever done. And we said, no, you're exactly right. And the burden properly falls on us to show that this method is feasible and acceptable to the implementing organizations. And so we've spent the last 3.5 years working with a variety of organizations, as you can see in the first bullet here, across a lot of high-emitting industries, cement, steel, copper. We've gone petrochemicals, we've done discrete part manufacturing, healthcare, electricity, and showed how the e-liability method works. And it has worked, and it has not been burdensome to implement. And we've also done it around the globe. We've worked with entities in Asia, Europe, South America, United States. So it's not regionally dependent. It's a generally applied theory. And this is very important and we've learned from this. It's not just we've demonstrated in the process of implementation, we've understood more deeply the fundamental properties of the e-liability system and its theoretical justification. We've tried to create a community of practice among people at all the pilot sites, people from regulatory agencies, from technology firms, from auditing firms to come in. And we do these through periodic conferences, both together on site and also online, making it somewhat more accessible. This is how we're socializing the concept. We came across a very able economist at one of the central banks in Europe, and he thought, gee, this is kind of what central banks do. They collect data from all over the world, they integrate it, put it together. and publish it for the public good and how the global economy is working. And it said we could do the same thing to show how global decarbonization is working. So you've had a very productive collaboration with the central banks, and Karthik may talk about this some more in his remarks. And actually, as a result of that collaboration, Karthik led an effort to create a set of proto-standards, not the actual standards. We don't want to be in the standard-setting business, but what would standards comparable to accounting standards look like for organizations to implement the e-liability, but also the e-asset side, I'll talk about that in a moment, in practice. And so that's been developed and it's publicly available on our website, the eLedgers Institute, for you to find. And then as we've worked with the implementing organizations and prospective ones, they I have this question, I have that question. And so Karthik and I have started a series of 20-minute videos where we go into depth in one particular topic. It could be an applications topic, implementation, or it could be conceptual, and that's also publicly available. So this is the way we want to socialize the concept, publicize it, and be completely transparent and open. This is open source code for anybody to access. Now, in doing this, as he said, as we work with organizations, we continue to get ideas on extensions. So we hear about problems that we can address. And so after our initial paper in November 2021, we learned about all the offsets going on and the huge markets in these offsets. Some of them are quite questionable quality. And so we addressed that in our second paper with a third co-author who was a capital markets expert, Mark Roston, on how to do comparable kind of accounting when carbon is actually removed and indefinitely sequestered. Okay, removed from the atmosphere and indefinitely stored, kept out of the atmosphere for long periods of time. So that was our second paper. And as Karthik mentioned, we've, in our initial paper, focused only on upstream emissions, but we kept hearing from people, well, what about when customers use your product and have emissions? And we kind of ignored those. First, they're not controllable by the company that's producing the product that's transferred downstream, but also because they'd be picked up by a corporation. When the downstream company used it, the emissions they produced would get reported in our system. But we kept hearing this, so we felt it must be something here we should address. And we did this with a paper published a year ago on how to think about not the accounting for, but the disclosure of emissions, especially when used by end-use consumers, because we can't expect 8 billion citizens or residents of the Earth to annually produce their own e-ledger report. So how do we reflect the emissions that they produce? Most recently, and our working paper published just this month, posted on a public website, SSRN website, which academics will be familiar with, we actually went back in time to say we never really documented the underlying bookkeeping and accounting in the e-ledger system. And so for the last 2 months, Karthik and I worked on this paper, which is now public and posted, on the underlying transactions. First, when on the products that you purchased, how do you transfer the emissions from the selling company to the purchasing company? Second, when any entity issues or produces its own emissions, the direct emissions, which is really a transaction between that company and the Earth and its global store of carbon and the atmospheric carbon. So we have that transaction. And then we have the third transaction when you take the purchased and embedded emissions and assign it to your output products. As we've discussed before. So that's now available. And we're also work in process is to address electricity emissions. We didn't think we had to do this because electricity is a supplying company, so it was really covered in our first paper. But because, in a way, the greenhouse gas protocol carved this out as a separate category, there's been some unique and somewhat dysfunctional practices that have occurred. And so we thought we should address correctly how to measure and account for the emissions produced during the production and distribution of electricity. So, try to keep some thought leadership here. The ideas keep coming in, and we make this available as quickly as we can get our ideas down onto paper. So, Karthik, that's where we've been. Tell us where we're going.
Yeah, and before we do that, Bob, I just want to, if we can go back, just highlight a couple of things that you said. The first is, as we reflect on the pilots, I think there've been a couple of insights that might be worth sharing that are collective across the pilots. The first of these insights is that the calculation of direct emissions, initially when we started this process, I was worried that that would be a cost-prohibitive exercise. But we have found in a number of different settings that the calculation of those direct emissions is less burdensome than we first imagined. And that's because, of course, in any industrial process, you've got a series of chemical reactions. Those chemical reactions are already known. And so if you home in on those chemical reactions that involve the emission of CO2 or some other GHG, you only need to focus on those reactions. And then if you home in on the solid inputs or outputs from those chemical reactions and say, okay, are we already weighing the quantity of inventory of those solid inputs or outputs? And chances are we are, because, we need to do that kind of inventory management for our financial accounting books. Then between the imputation of the changes in the solid and the masses of the solid inputs and outputs and the underlying knowledge of chemistry, you can impute what the emissions were on a weekly basis in any facility at fairly low cost. And so, for instance, if you're in the process of making cement, then the core chemical reaction is one that converts limestone into clinker. The chemical formula there is well known. CaCO3 becomes CaO plus CO2. So if you're weighing in the quantities of limestone input at the beginning and end of each week, or the output of clinker at the beginning and end of each week in any facility, then you can impute the CO2 emissions without having, millions of meters on smokestacks. And so what we found is that even in complex production processes, such as the manufacture of car parts at, say, BMW, you can impute direct emissions at a reasonably high level of accuracy, what we would call the reasonable assurance threshold in accounting lingo, without having, creating some sort of chemical engineering full employment act, which is what I had certainly initially feared might be the case here. So that's been one insight. Bob, please jump in.
So the second insight is for those companies that are not running big chemical processes, they're just manufacturing companies. They actually have very few direct emissions. What they do have is the purchased materials and the emissions in them, and they have electricity, which is the purchased services. And again, when we wrote the initial article, I thought the allocation of the purchased and emissions, could be complicated. And it turns out it's actually really simple if it's just using electricity to run machines, because you just have to know the electricity consumption per minute of machine time, and you have different size machines with different horsepower motors, and how many minutes it takes to convert inputs to outputs. And so you just multiply those two quantities, and if you're getting the right emissions from your power supply company, that's the new article still to be written, you just multiply the CO2 emissions per kilowatt hour, the electricity you're purchasing, multiply by how many hours you're running the machine to convert inputs to outputs. So it's the conversion algorithm is quite simple.
Yeah. And then the final insight, perhaps worth sharing at this high level, is that, the sociology of this kind of transformation from a performative sort of disclosure-based approach to carbon, where you would sort of, create high-level estimates of, what your suppliers and your customers' emissions are based on some industry average or regional average numbers, and then report them out on a PDF. The sociology of the transformation from that mindset to this mindset where you're dynamically and accurately measuring your direct emissions, your suppliers' emissions are being transferred, and you're doing this sort of analog to cost accounting, that sociology is not necessarily straightforward, because people inside the organization need to get comfortable with this transformation. They need to get comfortable with the fact that new information becomes available as a result of this process. And they need to get comfortable with the fact that sometimes in the past, as a result of using industry average emissions and the like, they might have made some claims that now when they look at the primary data are not sort of validated. And so we found that, in fact, one of the more challenging elements or aspects of any pilot is to make sure that there's air cover from senior management to say that this is not an exercise to penalize people for things they did before they applied the system. This is an exercise to learn and get better at it, and so that we are able to competitively differentiate our products. So we want you to look forward rather than backward. We want you to be innovative rather than punitive as you think about the applications of these pilots. So with that, let me pivot into the third of our 4-point strategy or theory of change, which is to find ways to scale this approach. As Bob mentioned, we have now piloted this in a number of different sectors, a number of different geographies, various different company sizes, from the very small to the very large. But for this operation to work, for this kind of robust carbon accounting to work, as Bob said, it needs to be able to scale, and it needs to be able to scale economy-wide. And one of the things that's distinctive about carbon accounting relative to, say, financial accounting, in financial accounting, you don't need to know what your supplier's costs were. You certainly don't need to know what your supplier's costs were, and so forth, because effectively the information is transferred in the prices you pay in supply chains. But in carbon accounting, you do need a level of accuracy into the emissions incurred by your suppliers, et cetera. And of course, in our algorithm, each entity is responsible for calculating and having assured their own direct emissions. So how can that information be robustly and scalably transferred down a value chain without, cost prohibitiveness in that process? And we have found that blockchains, and particularly the use of distributed ledger and tokenization technology, offer actually a promising, low-cost, highly scalable vehicle to do this. So imagine, for instance, you're at the top or the beginning of a value chain where you're mining, say, 1 ton of metallurgical coal on a given day. And that 1 ton of metallurgical coal is, say, associated with 2 tons of CO2 emitted into the atmosphere. Then those 2 tons of CO2 are tokenized into something like 2 billion emissions tokens. And those 2 billion emissions tokens are then indelibly linked to the associated unit of inventory, which in this case is the 1 ton of the coal. And that link is basically then the 2 billion tokens become an inseparable informational property of that unit of inventory, right? So as that unit of inventory travels down the value chain, some of that coal might end up to make steel. That steel will then end up in this iPhone. Some of that coal might end up in, powering this underlying video call we're on. So as the proportionate amount of that coal makes itself into hundreds, thousands of different uses in the economy, the proportionate amount of those tokens, those original 2 billion tokens, follows the quantity of that coal. And so at any stage in the ledger, all you need to do is to count these fungible tokens. Now, the token metadata basically provides you with the information you need in order to trust the token. So for instance, the token metadata will tell you that this particular token is associated with the direct emission of a certain amount of, say, CO2 with a certain process on a certain date in a certain geography, and it's been assured by, say, this Big Four audit firm or this smaller audit partner or whoever it might be, right? And so it'll contain that data. So it becomes almost like a digital unit of currency, a digital banknote that you can fungibly add across many different entities. And the beauty of this system is that you get a unit of accounting transaction, which is the token, that is in some sense secure and private, because you can imagine that the underlying information, if you had a key and you opened the token and figured out what was inside it, that's proprietary information, because that has information on, say, the supply chain of your suppliers. It has information on the allocation decisions that those suppliers made, etc. That information might be proprietary, and your suppliers may not want that to be known many layers down the value chain, right? So what the token does is provide the secure metadata, which allows for the token to be fungible. The token is, of course, by virtue of being a blockchain, indestructible once created. So effectively, once a unit of emission is created, it has to sit somewhere in the system. You can't magically destroy it. So it provides an internal check on this. And given the fact that we've already invented this blockchain and distributed ledger technology, we say, here's a nice socially productive application of this, assuming, of course, as Bob has pointed out, that these tokens don't consume more emissions than they generate in the process of this accounting as we've described it. But the tokenization process and the distributed ledgers that go with it, these are really sort of valuable tools at scaling this method very quickly. Let me pause there and see if you wanted to add anything on the token before I go to this final part, Bob.
No, that was fine. The other key issue is interoperability, which is not a natural act for most technology companies. And we can't have only one technology company in the world that's doing this. So this is an issue that also needs to be sorted out in the months and years ahead.
That's absolutely right. And so the good news is there are a number of major technology companies that are already providing or producing prototypes of the kind of token that we described. They've been inspired by the work that we've done. But of course, they're trying to create proprietary platforms. It is the instinct of every technology company to be a monopolist, as we've seen in many, many times before. So what our role as the eLedger Institute, being a nonprofit, is to make sure that the underlying architecture of these tokens is fungible across different platforms. So if you have ERP company 1 that's making its platform, it's making its token, ERP company 2 making its token, there's no reason why you can't combine the tokens of these two companies because they all have the same metadata architecture. So that's our function, one of our functions, and that's this particular third stream of line of work that we as an institute have taken on, in particular with partners like the Finternet Institute, which is another nonprofit, but that has a comparative advantage in tokenization technology in the financial space. The final and fourth element of our strategy is to advance the eLedger's carbon accounting solution as an enabler for sound policy around the world. One of the things, as I mentioned at the beginning of this presentation, that has really happened in the last 3 or 4 years is that economic nationalism has become the dominant political narrative of the day. Now, we at the eLedger Institute have no comparative advantage in specifying what is good or bad policy relative to the rest of the noisy and busy policy ecosystem. But where we do have a comparative advantage is in providing sound underlying accounting to drive good policy. So we say, for instance, if you do want to have a trade regime or a tariff regime that effectively prevents the dumping of low-cost, low-quality products in your marketplace, one way in which you might be able to, and in fact, a really compelling and targeted way in which you might be able to build this advantage is to set up an emissions-based tariff. That is to say that the tariff is conditioned on the difference between the embedded emissions on a batch level, on a product level of imported goods versus domestically produced goods of the same product category. That is the spirit of the kinds of emissions-based tariffs now being considered in Washington, in Brussels, and many other parts of the world. And of course, if you're going to have a nuanced emissions-based tariff like this, then you need a tariffable basis. You can't have a tax without a taxable basis. And what the eLedger solution does is provide you with that kind of basis on which you can build this, because the eLedger solution is, again, technologically agnostic, ideologically agnostic, it's economy-wide, and it is independent of the geography in which it operates. Perhaps most importantly, it's thermodynamically consistent in the sense that it is consistent with the law of conservation of energy, the first law of thermodynamics. And so it is effectively scientifically the only sound way in which you can build this kind of regime. And so if this regime is going to happen, we can't see how this, as we've seen with CBAM in Europe or with the Foreign Pollution Fee Act in Washington, we can't see any possible way in which that regime can be effected without a carbon accounting solution like the e-ledger method. And the good news is that the policymakers who are driving that have come to the same conclusion independently that we have, and they have started to engage in this as a possible solution. Obviously, we have, again, no comparative advantage in that policy sphere, but what we do have is the ability to provide robust metrics. Those same robust metrics can help actually clean up the voluntary carbon markets. There's been a great bit of dismay over the course of the last 12 months or so as voluntary carbon markets have effectively collapsed, as trust in those markets have collapsed. I like to say that we're facing a sort of 1929 moment in carbon markets. 1929 is, of course, when we had the great stock market crash in Wall Street. And it led to a transformation of market institutions, not just in the United States, but worldwide, including in 1935, the invention of generally accepted accounting principles, or GAAP. So I think we're experiencing a similar sort of pivotal moment here in accounting, carbon accounting in particular. And so as these voluntary carbon markets start to, in some sense, go through a reset process, then what it is we are, or people in the market are looking for, is a fungible and verifiable basis over which they can now determine what is a credible removal and how it can be added across other credible removals that are out there to actually offset or net emissions. And that's what, again, our technological and ideologically agnostic solution provides. It provides the basis to rebuild the carbon markets to actually do what they were supposed to do, which is to decarbonize operations, rather than to enable performative but perhaps fake claims about decarbonization. So we see potentially the collapse of trust in carbon markets as a transformative moment for rejuvenation and an investment in a real accounting solution, parallel again to the analogies between the stock market crash in 1929 and the emergence of GAAP in 1935. This kind of carbon accounting solution, the e-ledgers method, is also something that can help drive governments that have a low carbon procurement approach. This was certainly US government policy until the recent elections in 2024. It is still a policy of many governments in other parts of the world. So again, to the extent that you have a low carbon procurement policy, you need a measurable basis that's fungible to do that. This is another reason why you'd want a solution like this. And finally, we've seen hundreds of billions, if not trillions of dollars of subsidies spent by the US government across all parties. That is to say, in the current administration and the previous administration, there continue to be generous subsidies for low carbon solutions. There continue to be generous subsidies for low carbon solutions in other parts of the world, including Europe, including the BRICS countries and so forth. And yet there doesn't seem to be to date a mechanism through which we can hold to account this kind of tremendous public spending. If we're spending hundreds of billions or trillions of dollars in subsidies on decarbonization, why are we not seeing perhaps a commensurate decrease in carbon molecules emitted into the atmosphere? So is the money being well spent? Are there other programs to which they should be targeted? Again, we wouldn't spend the kind of money we do in the financial accounting space or in the financial economy without a financial accounting system. So why would we do this in the decarbonization space without an underlying carbon system? So this is why we think that the core value add for the e-ledger solution is, once again, this technological and ideological agnosticism that allows it to be applied across a host of both cross-party objectives, cross-ideological objectives, but also apolitical objectives in a way that is scientifically consistent. And the good news is that across party identities, across geographies, whether it's the United States, whether it's Europe, whether it's the emerging world, we have continued to be able to engage with politicians and policymakers on this accounting solution precisely because they see us as not agenda-driven. And we think, again, that is a comparative advantage, not just for us as the eLedgers Institute, but indeed for accounting as a profession as a whole. In fact, recently we were engaging with the AICPA and the ICAEW, which are professional bodies of accountants in the US and the UK, and both of which are concerned about the declining enrollment of undergraduates in accounting curriculums. And one of the things that we've said to them is that by focusing on our comparative advantage and solving problems that people want to solve in the real economy, we can once again raise the salience of accounting across the world. So with that, let me turn it back to Bob for the final word.
Okay, well, but Karthik, I think, could you also just mention the trajectory of how do you get from where we are now to where every organization is on here? I might say that the benefit of the eLedgers approach is not only that it's ideologically and technologically agnostic, it actually also happens to be, we believe, correct. It's the system to give you accurate and, as Karthik pointed out, verifiable measurements. But people are puzzled, how do we get from where we are in the middle of 2025 to your idealized solution? Maybe just to take a couple of minutes and describe that transition.
Sure. And thanks for that prompt, Bob. So the core to this is the word that Bob used a couple of times in the beginning of this talk, which is recursion. Recursion is basically a computational principle where you solve a seemingly insurmountable problem by breaking it down into multiple iterations. The seemingly insurmountable problem we have here is how do you calculate in real time the embedded emissions in any product or service that transacts in the economy in all parts of the world? People must say, it's impossible to, we can see how in a perfect world your algorithm works, but how would you possibly do that? Now, if you were to solve this problem recursively, you would break it down into iterations and say in the first iteration, we work with just a handful of companies that focus on their direct emissions that are materially significant, as well as the direct emissions of just their tier one suppliers that are materially significant. So not even all tier one suppliers, just a handful of tier one suppliers and a handful of direct emissions within those tier one suppliers that are materially significant. That process, in some sense, is the priming of the pump. It kickstarts it, and at the end of that first cycle, those pilot entities have an output, and that output is a little more accurate than the status quo. But because of the circular nature of the economy, that output feeds into products in the economy, which in turn become inputs in the second iteration. So data in the second iteration is therefore that much more accurate. So as that cycle continues and as more entities come into that cycle, the improvement in accuracy is not linear, but geometric. And in fact, this is the central banker that from the Bundesbank that Bob mentioned earlier. He ran a simulation of this and said that, well, actually, you can get convergence to reasonable assurance, like a 95% threshold, in as few as 5 to 6 iterations. And that's because, of course, of geometric growth. Right? If you have geometric growth in the accuracy of the recursive process, you can get there pretty quickly once you've started priming the pump. And in the e-liability proto-standard that Bob also mentioned earlier, what we did is create a sort of turbo incentive there and said, look, in the first year of adoption of a system like this, we'll assume that you might be a lone ranger in this, And so if you don't have primary data in your value chain, that's okay. You can use the values from the 60th percentile of the emissions distribution for the particular product category that's missing, where the direct emissions are missing. But in the second year, we want you to use the 70th percentile. And in the third year, we want you to use the 80th percentile. And in the fourth year, we want you to use the 90th percentile. And by the time you get to the fifth year, we want you to use close to the 99th percentile.
Well, technically, we don't want them to use it. What we really want is to do the accurate number.
Exactly.
The penalty is that you have to report on a higher and higher percentile of the distribution if you don't report your accurate number in a verifiable way.
That's exactly right. So what you're doing basically is creating a turbo incentive to say, Don't get it right in the first year, it's okay. The penalty is small. Don't get it right by the fourth year, ooh, the penalty is very large. So you better get it right. By the fifth year, it's like failing the test. So then of course you want. So now, of course, whether that ramp up period should be 5 years or 7 years, that's a political consideration that, again, is not our comparative advantage. But we can provide the algorithm through which that scale up process can happen. And once you have that algorithm in place, the system is self-perpetuating.
So, Karthik, I think on that note, we can declare the end of the theory of change, and whether we reach that end state in 5 years or 7 years, we'll do what we can to decrease it, but it's somewhat out of our control. But we hope we have provided the path, the glide path, and the trajectory of how you go from a few implementations in a few companies to actually a global standard.
Yeah. And a final word is to say a huge thank you to Peter and Lori and the whole team at the ASWQ for their tremendous leadership in bringing attention to this and other innovations in the decarbonization space.